Happy New Year, everyone. In this episode, we'll go through property market predictions for 2024 by city. Okay, city by city, meet every day with a plan. That's what we're trying to do for 2024. Create a plan by knowing what to expect. We'll go through city by city. We'll go through different scenarios, interest rates, etc. We'll also go through the infrastructure spend, how much housing supply shortage there still is in 2024. And at the end, we'll sort of talk about a long-term forecast and why Australian property is still the safest bet for short and long-term wealth creation in 2024. Really excited for a big year. Let's get into it. My name's PK and I help people build passive income through the Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. This channel talk property, the economy, and financial happiness. Hit the subscribe button, give the notification bell a on, and give it a like. That would mean the world to me. What you're seeing right here is the boom and bust report by SQM, and they release this every year, and they're generally quite accurate. I mean, no one's perfectly accurate, definitely not the economists or banks. But this person isn't a banker. This person, SQM Research, they're not really an economist either. What I like is they provide scenarios, not just hey, here's the exact number and trust me. So let's go through this as the first chart of the video. I do want you to stay till the end because there's some pretty amazing data that I'll share that you might not know. It might completely change the way you think about wealth creation for your family. So base case scenario is scenario 1. Scenario 2 is energy crisis. Scenario 3 is base case plus very strong population growth of beyond 500,000 a year migrants into Australia. And scenario 4 is scenario 2 with that same very strong population growth of 500,000 migrants or more in 2024. And I just want to say, let's just make this real simple, right? Let's just cross off, we'll go through it a little bit, but let's just cross off 3 and 4 because the government has already announced that they're changing immigration policy to really make it more difficult for especially students to arrive in Australia and stay in Australia. And so the impact of that is really where students live, which is mostly inner city apartment type dwellings in Melbourne, Sydney, Brisbane, etc., capital cities. So maybe, like I always say this anyway, maybe those aren't the best types of property to invest in right now, but we're seeing that government is trying to bring that immigration level down below 400. So, I mean, they just don't have the political capital to carry on letting so many immigrants through more than 500,000 a year anymore when the long-term average is between 1 and 200,000. So I don't think 3 and 4 will pan out, but let's go through 1. Base case cash rate ranges from 4.1 to 5%. Okay, so it's just kind of there at the moment in the early 4s. As you know, as I record this in January 24, could that rise? I think there is a possibility of maybe another 1 or 2 interest rate rises, but really what we're seeing globally, especially with the Fed, is a different rhetoric. You know, they're really now more dovish on interest rates, and globally central banks are now positioning to reduce interest rates, not like dramatically, but definitely multiple times in 2024. Australia was delayed in raising interest rates. It will be delayed in bringing them down. I don't think they'll come down at all or in a big way in 2024. So I think this is about right, 4.1 to 5%. Maybe they end the year at, with a 3 in front of them, or maybe they end the year at what they are now. But I think this is generally speaking correct in Australia. At least things that are driving inflation and that could cause interest rates to rise are like energy costs, fuel costs, rental prices, etc. Those are things that are more supply side led. So interest rate rises, even though that's the blunt instrument that the RBA uses, the government uses, it doesn't really help fix a supply side problem, something that's causing inflation for a supply side. Anyway, waffle on. Population growth slows to 460 or less. So I think, yeah, population in this calendar year will slow to about that much, and then the next calendar year bring it right down below 400,000. Unemployment rises to between 4.5% to 5.5%. Right now, unemployment's still below 4%. generally speaking, when interest rates rise, there's a lag effect of 1 or 2, 2.5 years. That is when unemployment really starts to rise. Now, in recessions, I still maintain we're not going to enter into a recession. I know other YouTubers, other places, they call that we're already in a recession. But guys, a per capita recession is not really a true recession when you've received almost 1 million new immigrants. Per capita is per person. If you have the same economic growth and then another million almost people in the country, of course, per capita GDP growth is going to come down. So I don't take that with, that much conviction. I look at absolute GDP growth numbers, and they're still fairly buoyant. I don't think we're going into a recession. But if we do, which I don't think will happen, recessions come of two types. One is where unemployment rises by about 1 to 2%, and another, it rises between 3 to 4% or more. Generally, the former is much more common, especially a shallow recession, which is probably what we will have if we have one, which I don't think we will. I've done other videos on that. But unemployment, I think, will rise. I don't think it will rise to 4.5 to 5.5% this year. I think it could in the following year, in 2025. But, right now, labor is still very in demand. Employers are hoarding labor, and we still have a skills shortage. So I do expect this year to be in the 4s, but perhaps not in the 5s. But I do think this is a fairly accurate representation of what the economic landscape could be. And you can see Perth in that backdrop is likely to rise by 5 to 9%. Brisbane, 4 to 8%. Darwin, -3 to +1%. Melbourne, -3 to +1%. Sydney, -4 to 0%. Adelaide, 0 to +3%. Hobart, -7 to -3. Canberra, -8 to -4, and the capital city average weighted, because of course Melbourne and Sydney take the lion's share of property transactions, -1 to +3. And that's obviously so bad because it's mostly reflective of Melbourne and Sydney, which aren't predicted to do that well. Let me now just go through and give you my interpretation, because I don't agree with these numbers per se at all. So let me give a bit of rationale. You can disagree with me, but take it for what it is. My thoughts based on all the data analysis and research, thousands of charts that I've shared with you over the years, and my knowledge. So I think Perth is fairly representative here of what may happen. It's really the lower end of Perth that is booming along. In fact, that's growing at more than 20-25% per annum right now. It's the million plus, 2 million plus that is kind of flat, sometimes even going down. But I think that cycle will start to shift, where the affordable properties that used to be 300-400K are now almost, in some instances, gone up by 50, 60, 70% in 1 or 2 years. Those will start shallowing out in some cases in terms of their growth. And then the middle ring, 600 to a million, those properties will start going up in price. Generally, cycles happen the opposite way, where the expensive properties go up first and then it tears down to the most affordable properties rising. This time in Perth, it's happened the opposite, because we've experienced such higher interest rates in a short period of time. And so there's been a flight to affordability. And so now I think Perth overall, I think this could be accurate. I wouldn't be surprised if it goes into double digits, especially if that mid-tier market, kicks into gear. But I think this is fairly representative. Brisbane, Brisbane was very interesting. I did so many videos in 2023. The Brisbane market started moving along. It started increasing. And I said, we need to wait till Christmas, because that's the selling season. If properties all of a sudden become on supply, on market, listings soar, then we might see this price momentum shallow out. And it didn't. Okay, it didn't. Prices continued going up because there wasn't a glut of supply in the spring, summer selling season. So I think Brisbane is probably unlikely to have double-digit growth on an aggregate level. Of course, markets within markets, there's going to be places that do, some places that don't. But I think this is fairly accurate of Brisbane. And then obviously, I'm the most bullish in terms of capital cities, which is not exclusively where we're buying, but predominantly. We're not exclusively buying in Brisbane and Perth. There are regional areas that are tipped to go even further beyond this. And I came out with, saying Townsville is going to achieve double-digit growth. I'll do another video on that. And let me know if you want one, by the way. Name a regional city and I'll do a video on that if I can, to try to give you guys some intel. But overall, I think capital cities, Brisbane, Perth, are going to perform the best. And I've said that for a long time. Darwin is kind of like, it's helter-skelter. It's sort of touch and go. Some suburbs go up and they flatline, they go down. Most recently there's been some announcements in terms of workforce exiting Darwin, transient workforce exiting with some mines, lithium, etc., not doing so well. So I think it might continue to tread water, or it might have a terrific year if people start to really see other areas like Sydney, Melbourne go down in price, and there's that flight. Investors want to invest somewhere. They might start snapping up cheaper investment properties because Darwin's very affordable. But then you have to be careful of buying in that kind of environment, because if it's investors leading the way price growth wise, then that's not necessarily sustainable. That's how bubbles occur, as opposed to booms, which are driven by owner occupiers, which is the case in Perth right now. Melbourne, there's so much value in Melbourne. I've always been bearish on Melbourne from sort of 2020, 2021, 2021, I would say, to sort of now. But I think right now there's so much value in Melbourne. The price disparity between Brisbane and Melbourne, they're almost, in terms of medians, almost the same now. Brisbane's almost caught up. But just because there's value, just because property's cheap from a historical perspective, or it hasn't gone up that much, as is the case in Melbourne, that doesn't mean that all of a sudden it will start rising. We need to see some sort of spark. We need to see some sort of, imbalance in demand versus supply for that to jolt into action. And I really can't see it. The economy, the state economy is in dire straits, and there's all sorts of taxes being put on properties, etc. So I think Melbourne for the main is going to be fairly, I don't think it's going to be negative as is suggested here. I think it will be positive, but not by that much. Sydney, they're very bearish on this. And me, I don't like Sydney property in terms of, I think we stopped investing there 2021. And since then I've been saying, don't invest in Sydney, don't invest in Sydney. You saw last year, or 2022, it tanked by around 10%. Then it sort of almost caught up to its record highs last year. But then the last few months, it's been sort of flat, if not maybe just dipping a little bit again. So it's very volatile at the moment, Sydney. It's sort of at the whim of macroeconomic winds, unlike Perth, unlike Brisbane, which have genuine engines of economic growth from a local city and state perspective. So I think, I'd love to say it's going to drop by 4%. I don't say I'd love to say that, but I've typically been bearish on it, but I don't think it will drop by 4%. I think it will be sort of -2 to +4, that kind of range. And of course, if interest rates start falling, if the Australian dollar doesn't continue to rise, if it starts coming back down because all of a sudden the inflationary environment comes back to bite the world in the bum, then I think Chinese overseas investors will flood back into Sydney. We might see some more tremendous gain. Tremendous, I don't mean double digits, but higher gains. Adelaide, guys, 0% to 3%. Yeah, Adelaide's a funny one. Even last year I said, look, it can't go on like this forever. It can't continue to boom double digits forever. I think this might be the last year that Adelaide does well. I think it might actually grow more than 3%. But as you know, my clients haven't invested in Adelaide for more than 12 months because we don't want to be investing at the tail end of a boom, okay? We want to be investing at the start or just before the middle of the boom. Hobart, I should also say as well, just because I've said this doesn't mean that, Adelaide's not going to be a good buy for the next 10 years. I'm just talking short-term cycles here. There's long-term cycles like 20, 30 years. There's then 10-year cycles in which time a city can go up and down like 3, 4 times. And then there's short-term cycles like 2 or 3 years. So Adelaide, Brisbane, Perth, massively bullish over the long term in terms of 10-year horizon, not super long, but 10-year horizon. But right now in this sort of small cycle, this 2 to 3, 4-year cycle, I think Adelaide's kind of almost had its game. Hobart, -7, -3%. That's very bearish from SQM's perspective. Hobart's economy, there's still a lot of infrastructure. I'll go through that in a second as well. A lot of infrastructure going on. They have like a solid base. It's not just retirees from Victoria who are outpriced in Melbourne and then moving down to Hobart because it's cheaper, because it's not really that much cheaper anymore. So I think this is a little bit too bearish. I think it might be negative in Hobart, but probably not so bad as this right now. And of course, Hobart reliant on tourism as well. So it depends on the Aussie dollar, which is obviously trending in the right direction. If you're an importer, it's going up in value. That's great in terms of we're not importing inflation as much. That reduces our inflation, maybe means low interest rates as well this year. But tourism is a big industry for Tasmania, for Hobart, and that doesn't bode well if Australian dollar is going up, because it means people coming here, it's more expensive to do this so for them. Canberra vacancy rates are through the roof. I'm like, how can we have such a tremendous housing shortage, a rental shortage nationally? I was going to say globally, nationally, but Canberra's vacancy rates are almost approaching 2% in some places, which is still balanced, but it's definitely not tight anymore. And that's a leading indicator of what might happen to property markets in terms of buying and selling of property. So I think Canberra, -8%. I don't think so. I don't see that happening, but I do think it will be a negative in 2024. And the capital city average, you can see -1 to +3. If this wasn't a weighted average, like if it wasn't skewed to Sydney or Melbourne, I think it would be more like the long-term average in Australia over the last 30 years, which is kind of 4 to 7%. Now, scenario 2 says that cash rates rise above 5%. Now, what would need to happen for that to occur? That, really, we would need to experience a bigger war. Like right now, of course, in the Red Sea and Persian Gulf, etc., there's a lot of pirates that are interfering with cargo ships, with transportation lines, and that's causing transportation costs to go up. That's causing fuel to be like quite volatile. I did a whole video on that, and it's kind of panning out the way that I expected in terms of, perhaps Iran or other militias getting involved in trying to disrupt the unity of the Western democracies because they don't like what they see happening in Gaza, etc. And that could really mean that perhaps globally we see a disruption and oil prices rise. But I just don't see cash rates rising above 5%, because if oil prices rise, that's actually a negative thing for global growth. And if global growth starts to reduce, then cash rates don't go up, they go down. And raising the RBA cash rate doesn't reduce inflation that's caused by oil spikes, somewhere around the world. So I just don't see this happening. Rates above 5%, maybe famous last words, but let me know what your thoughts are as well. Unemployment rises above 6%. There's no way, unless you have some sort of COVID type event where it went to 9%, there's no way it can go from like below 4% to above 6%. That's a 50% increase in 12 months. Like that unemployment doesn't rise that quickly unless there's a shock like COVID. Inflation reignites back towards 7% following Middle East embargo. That could definitely happen. Oil led, but once again, fuel or oil is just one commodity. Everything else is basically coming down unless we see bigger tensions. Maybe Taiwan, maybe Russia do something else that's a little bit crazy and unexpected. Never say never, but I don't see that happening. And population growth slows back down to 460,000 or less, which is the same as scenario 1. So in this case, Perth, you can see it goes up the same. So Perth, because once again, I want to demonstrate macroeconomics are one factor in property prices. Local economics are another somewhat more important factor in driving property prices up and down. And so you can see, according to this analysis, even though macro, we are worse in scenario 2, Perth will do exactly the same. So it's a low risk move, if you ask me, in terms of property buying in Perth right now. Brisbane also goes up, but much less this time. Darwin goes down, Melbourne goes down, Sydney down big time, Adelaide down, Hobart down big time, Canberra down huge, and overall the property market falls. So I think this is a little bit too much. Maybe the reality is somewhere between 1 and 2%, in which case you would still put your money where I've mentioned before, which is Perth and Brisbane, because those cities are likely to go up regardless of how tragic macroeconomic headwinds become. And then, of course, if population growth continues to go up and somehow rather, approaching an election year as well, there's some political capital to accept this many immigrants, then, of course, Perth, as you can see, continues with the same because it's locally driven, not internationally driven. Brisbane does much better because a lot of those migrants do come into Brisbane, Sydney, and Melbourne initially in terms of absolute numbers. Now, interestingly, Perth has had the highest population growth on a percentage perspective, but on absolute numbers, Brisbane, Melbourne, Sydney get the most. Darwin, doesn't do as bad, and all down the grounds, they don't do as bad. But I don't think 3 and 4 are politically going to happen. I've got a few more charts to share, so don't go anywhere. But let me know in the comments right now, open up the comments. There'll be a few trolls in there, I'm sure, but comment right now which city you think is going to perform the best. And you guys can hold me to account at the end of 2024, and I can hold you to account in the comments. Of course, you'll post anonymously, but it is what it is. Now check this out from the National Housing Finance and Investment Corporation, Australia's household formation and housing supply balance. It just gives us a demand versus supply, how much shortage there exists for houses in Australia. And so this blue or purple line is supply, and the green line is demand based on housing formation, number of people in a house, etc. You can see that this chart down here, this bar chart, is if there's a surplus of houses, it's above 0. If there's a shortage, it's below 0. And so in 2024, there's a shortage. In 2025, that shortage exacerbates. 2026, it gets smaller, but it's still a massive shortage. Gets smaller. The shortage only ever dissipates in 2029. So if you're sort of thinking, look, I'm really not sure, interest rates are really high, there's wars going on, cost of living is high, what's a guy to do, what's a gal to do? Guys, don't take my recommendation on face value. Don't trust anyone, not even me, only trust the data. But you can see here, we're in for a terrific decade in terms of property investment, property price growth, because numbers don't lie. And these are clear numbers of ongoing housing shortage in Australia. And it's not like the price momentum will slow down because infrastructure spending is coming to an end. In fact, quite the opposite. Check this out. So we're kind of in 2020 around this, beyond this line now, and the infrastructure is just about to peak. It keeps going up. And of course, a lot of this has been delayed. So a lot of this peak is now happening in 2025. So we're still climbing the Everest summit in terms of the amount of billions of dollars that are being spent in both private and public, road and major public infrastructure in Australia. All those things creates jobs, all those things improves connectivity, all those things means a vibrant and buoyant economy. See what WestConnex did for Sydney, positively created a property boom. Now, of course, this doesn't just happen everywhere. There's markets in the markets, 15,000 suburbs, but at a macro, it's really interesting to see that these next 2 years, from an infrastructure perspective, and of course, this graph can change. They can add more infrastructure on later. In fact, they do. It's not like they don't release new projects, they don't create new projects. It's not just falling off a cliff in 2026, but right now we're seeing it go up and up, which bodes well. And then lastly, that age-old debate, property versus stocks. I'm in 2024, at the start of 2024. Let's say I'm a family man. Let's say, I work a job, I make 100K, 70K, 150K, 200K, whatever, household income, 100K, 300K, whatever. I want to create long-term wealth for my family so I can retire early, I can leave intergenerational wealth for my children. What do I pick? Now, I can't give you any financial advice, but check this out anyway. The sources are numerous, like REIA, ABS, RBA, ASX, AMP, but it says long-term asset class returns. So how much would 100 Australian dollars invested in 1926, this is before the Great Depression, okay, when everything tanked, how much would that be worth now? Now, if you invested on Australian shares, it has gone up on average 11.3% per annum, which is pretty remarkable. Sometimes we know this figure as 7%, but that's only the last 30 years according to the RBA. Longer term, pre-depression, 1926, it's actually 11.3%. Australian residential property, 11%. So basically the same, 0.3% less, but it is basically the same in this blue chart. You can see this blue chart is much less volatile, this blue line, than the red line. This red line goes up and down, up and down. You lose sleep at night, at least I would. But this blue line is relatively speaking more smooth, but having performed at the exact same rate. Australian bonds, fixed income, corporate bonds, etc., 6.6%, almost half. And then Australian cash, you leave your money in the bank, this black line is 5.3%. So what's the moral of the story? Of course, make up your own mind. Don't let me be a property spruiker. Moral of the story, get your money out of the bank, because right now inflation is meaning that any money in your bank, you're not actually earning any interest on it, because in real terms, you're just getting zero return on investment. But even forget real terms and forget inflation, just relative to a proper asset class that creates growth, that creates wealth rather than just preserves it, right? Australian cash has performed less than 50% as well as both stocks and property. Now, of course, you can decide what you want to choose, property or stocks, but let me ask you the question, are you comfortable taking out an 80% loan to invest in the stock market? Not many banks will even let you do that because they know it's a bad idea. Of course, CFDs, NAB has a product that allows you to do it. But generally speaking, how many average, normal, everyday people, Aussies, are getting out 80% loans to invest your money in the Australian stock market? Not many, okay? You're putting in $50,000, making 10% return, $5,000 that year. Fantastic, high five. But you're doing that, Australians are doing that in property. They're getting out 80%, 90% loans. And so using that power of leverage, Australian residential property has far superseded Australian shares with that concept of leverage for the everyday person. Of course, hedge funds, they get out big loans, but everyday person. Guys, that was my thesis on 2024. Long-term, really good. Infrastructure, really good. Housing shortage means prices carry on going up. And also Perth, Brisbane to grow the most. Different scenarios, but I think we are in for turbulent times from a macroeconomics perspective. Perth will be almost not affected or the least affected. Brisbane, a little bit more so, but still have a stellar year. There's regional areas I haven't covered in this episode that will also, beyond even Perth, perform really, really well. I'll do another video on them if you want. Leave a yes in the comments if you want that. My name's PK. If you enjoyed this, got value, hit the subscribe button, give it a like, and tune in. Give that notification bell and tune in for the rest of the year. It's going to be a terrific year. I want to try and make you guys a lot of money by not giving me money, but doing it yourself by investing in the real estate between your 6 inches. Thank you, everyone. See you later.